Natural gas is quietly shaping every energy decision you make this summer, from power bills to factory schedules. A string of headlines shows traders wrestling with LNG flows, storage tightness, and weather-driven swings that can flash across continents in hours. In Europe, a brutal balance between supply and demand has sent spot prices higher, while in Asia and the Americas, buyers chase cargoes that can be delivered yesterday rather than next quarter. This topic matters because even small shifts in gas can ripple into electricity costs, industrial competitiveness, and inflation expectations that influence policy and markets worldwide. This year, natural gas is the fuel that powers heat, electricity, and many industrial processes. At its core, the price is the balance between how much gas producers put on the market and how much buyers need for today and next season. Right now, LNG vessels are shifting from storage pools to customer markets, while European gas storage nears seasonal lows and US production trends remain stubbornly steady. Weather drives demand spikes from air conditioning to heating seasonality, making forecasts a game of weather models, stock data, and logistics deltas. When one side tightens, the other inevitably tightens too, amplifying volatility today worldwide. Natural gas has lived in the shadows of oil for most of the modern energy era, until the shale revolution unlocked abundant supply in North America and LNG projects multiplied worldwide. Historically priced by regional hubs, gas moved on pipelines and cooling contracts before globalization stitched markets together. The 2000s brought surging LNG capacity, the 2014 price crash, and the 2020s volatility from weather, policy, and geopolitics. Storage strategies, futures curves, and arbitrage between hubs created a complex ecosystem where a single weather shock or a cargo delay can tilt entire regions. This backdrop helps explain today's tightness and expectations. Prices have reconnected with the basics and then some. Spot gas in Europe traded above €1,000 per megawatt hour at times last winter, while benchmark US Henry Hub futures hovered in the mid-two digits, and LNG freights surged to record or near-record highs when cargoes were scarce. Utilities faced higher power costs, industrial buyers rerouted gas, and electricity grids leaned on gas plants to keep lights on. Traders watched storage injections, withdrawal cycles, and weather models, treating each cargo as a potential price trigger rather than a routine commodity move. Volatility remains the new normal everywhere. Who pays the price includes utility companies balancing bills, industrials shifting feedstock costs, and LNG traders chasing cargoes to avoid outages. Power generators rely on gas-fired plants for reliability, while coal and renewable rivals jostle for market share depending on price and policy. Pipelines owners and LNG terminals see variable cash flows as shipments rise or stall. Asset managers, pension funds, and hedge funds adjust risk models to reflect gas volatility, while governments monitor storage adequacy and price caps. In sectors like fertilizers and petrochemicals, ammonia and methanol costs track gas feeds, shaping earnings and capex plans for years. Geopolitics and macro forces frame every move in gas markets. Europe's quest for energy security accelerates LNG diversification away from single suppliers, while sanctions and countermeasures ripple through pipeline flows and pricing benchmarks. In Asia, sustained demand from industry and cooling markets drives competition for cargoes and term contracts. The United States benefits from shale expansion, yet cannot fully decouple from global prices. Central banks fight inflation. where utility bills lag behind core rates, complicating policy. Supply constraints, weather risk, and currency swings compound hedging costs for buyers and sellers who rely on robust logistics to avert disruption this year. Smart money is reprogramming risk appetites rather than abandoning gas altogether. Hedge funds tilt toward curvature and basis trades, buying near-term while selling longer tenors to capture seasonal patterns. Utilities and sovereign funds bolster storage while locking in modest futures hedges against price shocks. Energy names with exposure to gas assets attract flows from LNG developers to pipeline operators, while traditional energy peers diversify into renewables to balance portfolios. Retail investors increasingly consider gas equities as a hedge against inflation, yet they lag institutional drills in risk management, seeking transparent guidance on contracts and settlement conventions beyond headlines today. Every thesis carries risks that keep traders honest. A milder summer or milder winter can drain the bullish gas case, forcing storage builds and lower margins. A failure to secure LNG cargoes due to vessel bottlenecks or sanctions could widen price gaps between hubs and widen backwardation. Geopolitical flare-ups, continued pipeline politics, or a policy shift toward aggressive decarbonization may dampen long-term demand. If U.S. supply unexpectedly slows or Europe accelerates coal burn, volatility could spike beyond current ranges. Testing hedges, credit lines, and project finance models across the entire gas ecosystem for banks, traders, and energy customers alike. For individual investors, the best posture is context and caution. Start with education to understand the gas curve and how storage, seasonality, and LNG flows drive prices. Consider diversified exposure through broad energy or commodity ETFs. Rather than chasing the most volatile cargo, use small, defined risk bets and avoid over-leverage during rapid spikes. If you own producers or utilities, look at balance sheets and hedges rather than headline momentum. Set price alerts, track regional benchmarks, and stay aware of policy shifts that can alter demand. Remember, the goal is resilience rather than speculation. Stay patient, use safeguards, and learn. Looking ahead, natural gas is likely to remain a weather-driven, infrastructure-connected market where tightness and price spikes recur, but longer-term trends may temper volatility as LNG capacity grows and storage strategies evolve. The macro backdrop of inflation, power market reforms, and climate policy will continue to shape pricing signals, while geopolitical risk remains the wild card pushing cargo flows in new directions. Investors should monitor regional benchmarks, stay clear on hedges, and follow the energy mix, shifting toward reliability and flexibility. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.